It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of Bank Information. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show. Well, if you were listening to the show last week, you knew my voice was pretty rough. I was getting over COVID, and I was sharing some of the, just my personal journey of getting COVID the second time. I got it 2 years ago, back in 2020, January 2020, actually. I got it before anybody really knew what it was. So, and then, of course, I got the Omicron version here most recently. Neither was fun. I was not vaccinated, obviously, in either case. Didn't take anything special, just mostly supplements and vitamins and things like that, and powered through it and got better. So my voice definitely is a lot stronger today than last week. I'm sure you can tell. Still a bit of a cough, so I apologize if I have to take a bit of a cough. I'll do my best not to. But anyway, what I wanted to talk about today, discuss, I think it was very interesting. I had a very interesting meeting with a potential client yesterday. And I often share actual experiences, situations that are real, that I'm dealing with on a daily, weekly, regular basis. So I don't share any personal information so anyone, could know who I'm talking about. But I'm going to share. I share enough information that if you happen to be, if this person happens to listen to the show, she'll recognize the discussion. And I get that quite often. It's kind of funny, where I'll share different discussions and experiences with different clients and potential clients on the radio. Again, I don't share any personal information, but there's enough that share. They're like, wow, you were talking about me. I'm like, yeah, I was talking about your situation. And I like to do that because it's real world. It's fresh. I just did this literally yesterday. So this was a person who's been listening to the radio show for a fair amount of time, a few months, and was intrigued by the personal bank concept. And, we answered some questions, explained a little further how it worked, and she really was wanting to get an idea of how it could work for her. And she had a couple of situations that I find very common, run into quite commonly. That's why I think it's so valuable to share. The first thing she was thinking about in terms of doing this was, like she said, she goes, I have some funds coming in, and she wanted to fund some college education for her grandkids. And the personal bank concept, the life insurance, the cash value life, the dividends, is actually one of the number one funding tools for college funding in the country. It's a lot of advantages. One, money grows tax-free. You can access it tax-free. And for any purpose, 529 plans typically are only tax-free if used for educational purposes, which is probably the type of college funding most people are familiar with, are the 529 plans. The other advantages I think Personal Bank has over it, just so you know, I'm not going to spend a lot of time with this, but on college funding is, the gains are basic, consistent, steady eddy, guaranteed returns. So you don't have to worry about what the market's going to do or not do over the next 5 or 10 or 15 years, however time frame you have, for this college funding plan. And then the other one is assets. The assets with the policy don't go in the FAFSA form. And if you don't know what that is, excuse me, the FAFSA form is the form that students complete for student loans and grants. Okay. And assets in a 529 plan, of course, are typically counted towards that, where those in a personal bank policy are not. So it can definitely make a difference on whether someone qualifies for a grant or a loan or how much they get. In fact, I often tell the story. I have a doctor who, for 2 years, had 3 in college. He had twins and a third kid, all in college at the same time. And his point was the personal bank, by putting the money here, he saved $45,000 a year for those 2 years because he qualified for some grants and loans they would not have otherwise. So the difference for his particular situation was significant. It was huge. And then, like I said, and these are self-funding too. That's the other thing. Because there is a lot, we're doing this to grow cash value, to earn dividends, if you're going to fund this, say, for a college education fund. The money grows over time, like any investment. But if something does happen to you prematurely, there is a death benefit associated. So if you, as a parent or grandparent, didn't lived long enough, so to speak, something happened prematurely, the death benefit would fully fund the college funding plan and then some, frankly, in most cases. Where if you take a 529 plan or some other type of investment, obviously it takes time to build that nest egg over time. So when you add up the differences where it's self-funding, like I said, you can grow the money and access the money tax-free for any purpose, not just educational purposes. Doesn't go on the FAFSA form, and it doesn't have any market risk. There's a lot of reasons for folks to use these as college education funding tools, one of the most common ones in the country, so very commonly. So as I pointed out to her, she had several grandkids she was wanting to do this for, and of course this would work. The other advantage, of course, is with the personal bank concept, if those listening know this, is that when you access the funds, this is where it makes it unique and really powerful. When you access the funds, remember, we're typically accessing them from a bank line of credit, and the the line charge is less than the dividends we're earning, so we're picking up 2.5% on average, 2.5% positive arbitrage. Let's just say between 2 and 3% is the range typically. So in other words, I use a simple example. If your money's growing, say 5.75%, 6% dividends, we've got companies been paying that the last 25 plus years. Never missed a dividend for since literally before the Civil War. I say that all the time, share that all the time. And so you're earning 5.75%, 6% dividends. Let's say today in this low interest rate environment. So obviously we expect it to go higher in the future. But then you access the funds, and you're getting charged in the 3% range, which is what the bank line rates are. What's your money doing? And the answer is pretty straightforward, pretty simple. You're keeping the difference, right? So that's the power of the personal bank concept and the whole idea of this financial tool. Using the insurance dividends to grow the money. And then when you do access it, to use it for whatever reason, you access it from the bank line and you keep the difference. And that's what's so powerful about this. I mean, as I said to this particular person who I spoke to yesterday, and she understood it. She's like, yeah, that's really, really cool. I mean, the idea that I can actually earn interest or keep the difference on money I spent. I said, exactly. That's the true power of this tool. So as we were going through this, and like I said, if you just tuned in, I'm getting over COVID and got a bit of a cough, and I'm doing the best I can to not cough. But it comes up every once in a while. I just can't help it. I apologize. But I really wanted to get on the show and share this interesting situation and very common one that I run into with clients on a regular basis. So if you're thinking about a college funding plan, or if you're funding a 529 plan or some other program for educational purposes for kids and grandkids, I really strongly recommend you look into your personal bank. It's an alternative. It stacks up very strongly, like I said earlier, against 529 plans and other educational plans that are out there, very favorably in many ways. You can contact me at toll-free 866-268-4422 or yourpersonalbank.com. Now, the reason that was not the real reason I wanted to talk about this particular potential client, because where it got interesting was then she goes, okay, that's very interesting. She was interested in funding something along that line, but I said, well, tell me more about your situation, because she asked me, she goes, well, I've been listening to the show. I'm intrigued by the idea. What else could I do with this? How could this work for me? And that's the answer, or the question I get probably the most often from folks. And her situation, like I said, was not unlike what a lot of people I talk to and deal with on a regular basis. And what I mean by that is she's in the process of purchasing a house and actually selling 2 other houses in the near future, in the next few months. There's a lot of people that I'm running into, obviously, who are selling properties or, real estate properties in particular, because if you owned something, even just bought it a few years ago, the run-up in values of real estate have been phenomenal, unprecedented even in some places. So there are a lot of people looking at this, with interest rates. Well, they're going to go up. I mean, the Federal Reserve's told us that in the near future. In fact, expecting the first interest rate increase to happen in April here of 2022. That will affect real estate values. That'll affect the ability to borrow monies to buy real estate. It's probably going to affect values, certainly. Inflation obviously has an impact, but interest rates probably more than anything else. We're going into a significantly different interest rate cycle. We've been in the lowest interest rate situation, well, since the history of our country, frankly, since 1787. That kind of puts things in perspective, if you know what I'm trying to say. So my point is simple. Is there's a lot of folks who've owned some real estate and are either or seriously contemplating selling those properties because there has been such a significant run-up in values. And with interest rates increasing, that continued increase is probably not going to happen. I'm not saying real estate is going to continue to increase in value, but it certainly will probably be much slower, likely, and could even reverse to some extent, depending on where you're located and stuff like that. So my point to her was, whenever you have a significant transaction of monies, that is when your personal bank can really, really make a difference. And it can really significantly increase your return on your investments and create positive arbitrage. And I'm going to explain this further as we go forward because we're coming up on a break here pretty soon. But what I want to understand is, in her case, she was looking at purchasing basically $1 million property in Montana. And because of some credit issues, she had some, not that she has bad, her credit's not that great because she had some, what do they call it? Not some, somebody messed with her credit, okay? She's in the process of trying to get it cleaned up. But she wants to move forward, so she's going to have to put down roughly half, a little over half, is all she can get on the loan. She has the funds to do it. She has some savings. She has some brokerage account monies. And she's planning to take, something like $550,000, give or take, from savings and the brokerage account and purchase this property. And I asked her, for obviously, is there any way you can get another, loan that you could actually borrow more of the money and those kinds of things and get in her situation? No, unfortunately. And she wanted to move forward on this property. In fact, she was doing an open house that morning. She had just done an open house that morning on the property. So she was set on doing this in the next month or two. And I said, okay, well, there's an opportunity here. Because you're looking at moving over $500,000, in this purchase, taking it from a couple of accounts you have, there is an opportunity. And I'm going to talk about that opportunity in the next segment, so stay tuned. Don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. And like I said, if I have to cough, I apologize. Some people say, well, why, you could have the sound engineer knock it out. Well, I'm recording from home because I don't want to expose anybody because I'm just getting over Omicron. So if I have to cough, I don't have a sound engineer to take it out. I apologize. I'll do my best, though, not to. Anyway, what we're talking about today is a potential client situation that I dealt with yesterday, literally. And she had been a radio listener and contacted me about using Your Personal Bank as a college funding tool, and which is very common. It's a very common tool. It's got a lot of advantages. And if you miss those, I encourage you to go to the last segment, and you can go to yourpersonalbank.com and listen to the previous segment or the previous shows, or any of the previous shows for that matter. I talked quite a bit about in the last segment about how college funding I feel like this is quite superior product than 529 plans or many other college funding plans. And if you want more information on that, again, contact me at toll-free 866-268-4422 or yourpersonalbank.com. Now, what's interesting, about this particular client, this situation, was she wanted to know what else Your Personal Bank could do in her situation, how it could work for her. I get that quite often, obviously. And we talked about her situation. And in her case, she's actually getting ready to buy a house and sell 2 others in the next few months. And as I explained to her, I pointed out, well, that's when your personal bank can really shine. Because remember, the key is you set up a high cash value policy to earn dividends, and then when you access funds, you access it from the bank line, and the dividends you earn are typically more than the bank line interest they charge, so you keep the difference or create positive arbitrage. 2 to 3% positive arbitrage is the norm, and that's been the historical norm for the last 40 plus years. Okay, so it works in low, medium, and high interest rate environments because it's all correlated or relative. It's all correlated. My point with her was she's going to spend about a little over $500,000 actually, in putting down, because she's going to put a significant amount of money down on purchasing this house in Montana. And as I explained to her, I said, look, and she has the funds to do it from savings and brokerage account and such. And then she's actually going to sell 2 properties here in Arizona to move up there, obviously, and then kind of refill everything, refill the buckets, so to speak, right, when she sells the Arizona properties. And I said to her, here's the thing. Whenever you have these kind of transactions, and a lot of people today are selling properties because they've had tremendous historical gains on those, it creates a significant opportunity with your personal bank in particular. In other words, you can create positive arbitrage. And as I explained to her, I said, the key is, in her case, she's going to put, it's like $550,000 down and buy this house. And again, she's planning to do this no matter what. I mean, this is a done deal, basically. I said, okay. And she has more than that, of course, available. And I said, well, here's the thing. You can, of course, take that $550,000. And here's what I want you to understand. Please don't get the number, hang up on the numbers. It could be $50,000. It could be, $5 million. It doesn't really matter. It's all relative, right? This was her numbers, okay? That's another key I want you to understand is just, don't get hung up on it's add a zero, take away a zero. It doesn't matter. Principle works the same way. And so my point was simple. I said, you could take that money from your savings, from your brokerage account, and buy this property, of course. Or, and here's the thing, or you could put it into a policy. Here's the key. You put it in a policy to earn dividends. Like I said, 5.75, 6% dividends, and, been that historically higher than that, actually. Last 25 plus years, never missed a dividend since before the Civil War. So these are companies that are long-term, consistent dividend payers. So you can put the money in there to earn dividends, and then you can turn around literally, within a week or so, access it from the bank line of credit and buy the house. Now, you have to put a little bit more in because you're going to about 85% liquidity. But as I pointed out to her, if you put in about $600,000, let's say, into the policy, which I have folks do this all the time, then turn around, access, say, the $500 or so she needs to buy the house, to put down to buy the house, I should say, from the bank line, you can buy the house. Now, what's the difference? The difference is on that $500,000 she accessed from the bank line to purchase the house, she's going to pick up positive arbitrage, and in her case, 2.5%. Now, folks, that adds up to like $12,500 a year, each and every year the rest of her life. See, this isn't a one-time gain. This is every year. If she gets 2.5% positive arbitrage on that $500,000, which has historically been the case and currently, she'll pick up an extra $12,500 of interest gains each and every year on the money she spent on purchasing the house. Now, if you didn't get that, you didn't catch that, I'm going to say it again because this is so powerful. This is the power, the key, the takeaway, if you will, in your personal bank. Because the key is understanding the difference of taking that, $500,000 or so, $600,000 like she was going to do, and buy the house. What would happen? Well, of course, she would own a house. That's all well and good. But that $600,000 that she's using to put down, as I asked her, I said, will you ever see any gains from that money ever again? And, of course, the answer is no. Once you take that money and you purchase that item, in her case, a house, you give up control of that money for the rest of your life. You don't earn anything on it. Yes, you got a house out of it, but the money doesn't grow or earn or anything for her in the future, does it? And see, here's the mistake that I said that to her. The mistake that I see that the average middle-class American makes versus folks who are very wealthy or institutional investors, very savvy. We'll put it that way. You know, I'm on a bank board and all that. We deal with this kind of stuff all the time, right? And that's why she goes, yeah, I know. I said, the mistake the average American makes, the average middle-class, upper middle-class American makes, is when they have funds and they transact those funds through their hands, like in your case, buying a house, they give up control of the money, and they never gain anything from it ever again. A savvy investor, an institutional investor, a bank board, people like that, they don't allow money to flow through their hands without getting some kind of benefit from that money down the road. Or in other words, positive arbitrage. And that's what we're talking about here. And in her case, the difference was, again, like $12,500 of gains on that money she spent to purchase a house. Remember, she put it in the policy and then accessed it from the bank line and purchased the house. And some people, they get caught up there. I say, wait a minute. Think about it. Where's the money? The money that what'd you do? You put it in the policy to earn dividends. It's still there, right? Because did you access the funds from the insurance company or the bank? And the answer is, of course, the bank. So the money's still there earning dividends. And the dividends are higher than the bank's charging you access it. So again, you keep the difference. She goes, yeah, I get that. So I said, really the question you have to ask yourself is simple. You're going to purchase this house. You're going to transact $500,000-$600,000 to do this. She goes, yes. Do you want the $12,500 of interest, give or take, positive arbitrage in your pocket each and every year the rest of your life or not? 10 years, that's over $100,000, right? Difference. Do you want to earn it or you want to let someone else earn it? And folks, that's the power of your personal bank. That's the difference. Now, I went further on it and explained to her what she could do on the backside on the sales of the two properties she's going to do in Arizona. And I'll explain that in the next segment. So, because we got another commercial break we got to take care of. So I'm going to really encourage you to stay tuned in the next segment because I'm going to share the last part of this. So don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to Your Personal Bank Show. And again, if I have to cough, I'm going to apologize in advance. I'm recording from home, so I don't expose anybody to this. I'm just getting over Omicron. But anyway, today I'm discussing a situation with a potential client that I dealt with literally yesterday, so it's very fresh on my mind. And she'd been a radio listener, contacted me about using Your Personal Bank as a college funding tool, which of course can work very favorably. I think in many ways more favorably than 529 plans or other types of college funding plans. If you want to know why, go to yourpersonalbank.com, listen to the previous segments, I explain it, or call me at toll-free 866-268-4422 for more info. But she asked me the question of what else could I do with what else could Your Personal Bank do for me? And I get asked that all the time. And excuse me, she's purchasing a house in the next couple of months, and then she's going to be selling a couple of other properties. And it's those transactions, as I explained to her, that creates opportunities to create positive arbitrage with Your Personal Bank. I mean, look, you could do it any time you wanted to. But what I've found, it's human nature. It's when people tend to do these transactions, particularly larger ones, the money's already moving. She's taking, in her case, over $500,000 she's going to put down to buy a house in Montana. And then she's going to sell two properties she has in Arizona and kind of refill the buckets. So she's transacting this money with or without me. But I explained to her, look, you can move $500,000, $600,000, and buy the house. And you'll, of course, own the house, but you'll give up use or gains or control of that $600,000 the rest of your life. And a lot of that's in a brokerage account stuff right now where she is gaining and has been gaining, right? That'll all stop when she uses that money to purchase the house, right? And I said, here's what the wealthy do versus the middle class typically. And it helps you understand why the wealthy keep getting wealthier. And the middle class seem to mark time most of the time. You know what I mean? don't really seem to get ahead as well. And here it is. When money transacts through your hands, a wealthy person or bank board or folks like that, they make sure that they get some gain, some benefit of that money down the road, even after it's not in their control anymore. Or in other words, positive arbitrage. They don't just give it up, all of it. That's financially foolish. So I explained to her, look, you have a choice. You can take that money and put it down and buy the house and you own a home. Or you can take that money, put it in a policy to earn dividends, then turn around, access 85% of it, like literally the next week, from a bank line, and use that money and purchase a home. Purchase the same home. What's the difference? In her case, over $500,000, she'd be picking up 2.5% positive arbitrage. Or that's $12,500 a year of interest, right? Not just, but here's the key, and that's, like I explained to her, that's on money you spent. That's on money you spent and used to purchase the house. You were going to do it anyway, right? But on top of that, it isn't just a one-time thing. It's every single year the rest of her life. Folks, in 10 years, that's well over $100,000, isn't it? Difference, more money in her pocket just by purchasing a house, which she's going to do anyway. And I said, now, if you want to take this to the next level or understand the next process, she's selling 2 other properties after she purchases this one here in Arizona. She's going to buy a property in Montana. She's selling 2 homes that are worth about $400,000 here in Arizona. I said, you're going to sell those, and what are you going to do with the funds? So she was going to reinvest them back into her brokerage account and such and refill her savings. I said, understandable. Of course, you could do that. Or you could sell the properties, take the proceeds, put it in the policy to earn the dividends, right? Access it through the bank line, then access the funds through the bank line and reinvest the money back into the brokerage account and replenish your savings. Again, what's the difference? The difference is, in her case, again, she'd be earning 2.5% positive arbitrage on that money. Why? Because she took the money and put it into the policy to her dividends and then accessed it through the bank line and reinvested back into the brokerage account. And in her case, she'd be earning 5.75 dividends and getting charged 3.25% interest from the bank. Did she take the money from the insurance company or the bank? Of course, the answer is the bank. The difference is 2.5%. And that's been historically the average over the last 40 years, by the way, 2 to 3% positive arbitrage, just so you know. So she picks up in the sales of those properties, she's expecting proceeds somewhere in the range of about $650,000, $700,000 on these 2 properties after everything's said and done, right? So she could pick up positive arbitrage on another $600,000, $700,000. Folks, that's $15,000 plus a year extra. Would that be helpful? So if she picks up 12.5 on the purchase side and another, say, 15 on the sales side, folks, she's picking up $35,000 a year extra interest or positive arbitrage every year for the rest of her life, just in 2 transactions, buying a property and selling a property. Folks, now you starting to understand why the wealthy keep getting wealthier? I'm going to encourage you to stay tuned in the last segment because I'm going to kind of flesh this out a little further and clear up hopefully any other questions you may have. So I'm going to really encourage you to stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to Your Personal Bank Show, and today we're discussing an actual situation with a potential client I had yesterday who's doing some real estate transactions. She's buying a property in Montana and then selling 2 properties here in Arizona. In fact, her and her family are doing what I think a lot of people these days are dreaming of. They're buying, in essence, a compound in Montana. Her and her son, I guess the family are combining their efforts and selling 2 properties here in Arizona so they can basically get out of Dodge, if you know what I'm saying, in case things get worse. And I'm certain they would have the potential to be off-grid if they wanted to be, that type of thing. And that's kind of a dream for a lot of people today if they're not already doing it. And so, I understood it. I commended her for it, and she was, set on doing this. In fact, she's planning on purchasing this Montana property and closing in April. And she'd asked me, after listening to the show and what Your Personal Bank could work, how it could work for her, And like I explained to her, and she called me about doing a college funding thing for her grandkids, and of course it'll do that. And if you want more questions or how that works, again, contact me at toll-free 866-268-4422 or yourpersonalbank.com. If you've missed the previous part of the show and you want to, again, go to yourpersonalbank.com, you can listen to this or any of the previously recorded shows. And before I jump into this, lastly, if you missed it in the previous segments, I'm getting over COVID. I'm recording from home, so if I cough, I don't have a sound engineer to get rid of the cough, so I apologize. But I'm powering through this because I want to get this out because it's I think, so valuable. So she's, again, purchasing this property and selling to others. And it's these transactions that create tremendous opportunities because in her case, she's going to be putting about a little over $500,000 down on this property. And then when she sells the other property, she's going to receive proceeds of somewhere around $600,000-700,000, give or take. And as I explained to her, look, she has funds in a brokerage account and savings to purchase this Montana property. And I said, look, you can do what you're planning to do. You can take $500,000-600,000, put it down, buy this property like you're planning to do based on her situation, her credit score, and all that. That's what works for her. Or you can take a little bit more than that, put it in, because you're going to have 85% liquid day one, just so you know. So I said, if you need 500, you put in something like 600 maybe into a policy. Then turn around, we set up a bank line of credit, we can do that within a week or so. Access the funds from the bank line and take the $500K or so and purchase the house. What's the difference? The difference is she's earning 5.75 dividends on the money she put in the policy and getting charged 3.25 on the money she's taking out from the bank, therefore keeping the difference of 2.5%. And on $500,000, folks, that's $12,500 of interest extra in her pocket each and every year for the rest of her life on funds she spent and used to purchase a house. So what is the difference? If you do it the traditional way that most people think of, you take the money and you buy the house, you have a house, that's all well and good. If you do this, you using the policy and the bank line and get the positive arbitrage, you still get the house plus an extra $13,000 a year in interest every year the rest of your life. Is that helpful? I think that's helpful for most anyone. Now, here's what I want you to understand. Don't get hung up on the numbers. Add a zero, take away a zero. The principle works exactly the same way. I'm just using her example, okay? That's what I dealt with yesterday. And I'm not sharing any personal information, so nobody will know who she is, except for her. If she listens, which she probably does, she'll probably reach out to me. I get this all the time because I share examples of people I'm working with on a regular basis without the personal details identifying anything. But they reach out to me. You were talking about me, weren't you? I said, yeah, I was, because there's enough information I'm sharing here that her and I know what this discussion we had yesterday, right? Now, that's on the purchase side. It's picking up $12,000, $13,000 of interest, positive arbitrage, and that's been the historical average for the last 40 plus years, just so you know, low, medium, high interest rate environment. So picking up about $1,000 a month interest extra just on the transaction. She's going to do the transaction anyway, right? So are we changing anything? No, we're just putting an extra $1,000 a month or so in her pocket. But I said, but it gets better. I said, look, you're going to sell these two properties, right? And you're going to get $600,000-700,000 proceeds from those two properties when you sell them after all the expenses. She goes, yes. And I said, what do you plan to do with the money? And she said she's going to refill her brokerage account and savings accounts, refill the buckets. I said, that makes sense. But I said, you can do that. Or what if you then took that $600,000 or $700,000 in proceeds, put it in a policy, then you can access 85% of it day one. So you take most of it from the bank line and put it in the brokerage account. You're accomplishing basically the same thing, except now you're picking up an extra 2.5% positive arbitrage, keeping the difference, right, on $600,000-700,000. Well, how much is that? $15,000, $17,000, $18,000, right? So if we pick up $12,000, $13,000 a year, positive arbitrage on the purchase on the Montana property, and we pick up another $15,000, $18,000 annual income difference on the sale of the two Arizona properties, we're at like $35,000 a year, aren't we? We're now like at $3,000 a month extra in her pocket every year for the rest of her life. Folks, Do you think that would help supplement Social Security or retirement income or anything else for that matter? And the answer is, of course it would. Of course it would. It would. I mean, she is retired actually already, but it would replace some. It would allow. She's taking money from her brokerage account to live on each month. Well, she could reduce how much she's taking by almost half. Would her money go farther? Yes, with inflation and the way things are going at the moment, that's really powerful. Could it be the difference for someone to be able to retire? Yeah, it might. You see my point. People are making these transactions as we speak. They're selling properties or buying properties as we speak. And this could hold true for any transaction, folks, right, frankly. What if you're not buying a property? I mean, what if you're not buying or selling a house? Well, I'm also running into a lot of people recently who are reallocating their portfolio. And what do I mean by that? Most of you know what that means, but the economy is changing. Interest rates are going up. Federal Reserve's telling us that straight up. That's going to change which type of stocks in the market and the economy and the markets that you probably want to own, or change the percentages at least, right? So a lot of people are reallocating because we're changing. The economy is changing, and it makes sense. You should be doing that, frankly, or at least looking at it. I'll say that much, right? Well, if you're already going to be making transactions where you're reallocating, which means you're selling some positions and you're purchasing others oftentimes, you can do that reallocation. And like I said, you really should look at it, especially right now. But you can do the reallocation and adjust your risk. Or you can do the reallocation and say some of those funds because once they're sold, then whatever the taxable implications are, they are. That all that stuff happens because a lot of times people are reluctant to reallocate funds in a brokerage account, for example, or portfolio because there could be tax consequences and things like that, which I completely understand. But if you're doing that anyway, right? Because you're wanting to reallocate your portfolio because of the changing economic situation and the risk that's out there, and which types of stocks and which types of sectors are probably going to do well in the future versus what used to do well. You know what I'm saying? I mean, it's no secret. Tech and the high flyers have been hammered recently, right? And a lot of people call the more boring stocks and things like oil, of course, have done really well lately. And that wasn't true even a few months ago, right? So if you're going to reallocate, why not take those funds once you've sold that position? So whatever the tax issue is, it is, right? You've calculated that in, hopefully. But the reality is, you've done the transaction. Why not put it into a policy to earn dividends? Then set up the bank line, access the funds from the bank line, like say you can access 85% day one, and reinvest. What's the difference? Well, in most cases, you're going to pick up 2 to 3% positive arbitrage. What does that mean? You're going to add 2 to 3% average annual return to your investments. Now, look, some people said to me, that's not a lot. Doesn't seem like a lot, 2 to 3%. I'm talking about extra, icing on the cake. So in other words, if your average annual return is 7 and you pick up 2-3% positive arbitrage, you're now making 9 or 10% on your returns on your portfolio, or at least that portion of it, right? If your average annual return is 10, you just increased it to 12 or 13%. In other words, you increased your average annual return by 20 to 30%. Folks, I don't care how you cut that. That is huge. That is a monstrous increase. A 20 to 30% increase each and every year on whatever your rate of return is. For most people, the difference is huge. The amount of money you're going to have going down the road, going forward, would be significantly more. And look, am I telling you to change anything that you're doing? No. Did I tell you to reallocate? No, you decided to do that because of the economic situation or the interest rate situation, whatever. My point is, folks are, like I said, naturally reluctant if something's working to take money out of it to put it into a policy and access it to the bank line and reinvest. Because there could be penalties or tax consequences or whatever. I get it. But when you're doing the transaction anyway, like this lady where she's purchasing a property and selling to others anyway, this money is going to change hands anyway. These reallocations of funds and these portfolios that a lot of you are doing as we speak or looking at it, are happening anyway. That creates your opportunity to pick up positive arbitrage, unlike maybe you've ever had before. You didn't have that opportunity before. So you see, my point is, it's a simple question to answer. And it's a simple thing to contemplate. Like I said to this lady yesterday, I said, well, you're doing these transactions, purchasing these properties, or when I talk to people, they're reallocating their portfolios, or suddenly they come into some funds, or they want to take some money and invest in something. I said, you have a choice. It's really quite simple. You can purchase that property or sell that property or invest in that asset or reallocate your portfolio or do whatever it is you're doing. Or you can do exactly what you're doing, but add one step. Put it in the policy to earn dividends. Then access it through the bank line and invest in that asset. Purchase that property, sell that property, reallocate your portfolio. Whatever it is you're doing, whatever it is you want to do. And the difference is you're going to pick up positive arbitrage. You're going to pick up 2 to 3% on average annual every single year the rest of your life. On $100 grand, that's $2-3 grand. On 50, 500 grand like the lady I was talking about, we're talking about 12,000-13,000 a year. In fact, think about it. I have clients who have done these kinds of things where they've moved significant chunks of money, put it in the policy, then access it through the bank line and did their investing or whatever it is they were doing and picked up the positive arbitrage and are now earning $20,000, $30,000, $50,000 a year now just in the positive arbitrage. That's if their investment does nothing. Absolutely nothing. Or they take the money and just spend it, right? You still picked up $20,000, $30,000, $50,000 annual income. Tax-free. With guarantees. Now, again, you start to understand how the wealthy operate with money and why the middle class make the mistake most of the time of giving up control when they're doing these transactions. When money moves hands, folks, that's the opportunity to gain positive arbitrage. So really, as I said to this lady, and I'll finish this up with this thought, I said, you're going to buy this house and you're going to sell these others, whether you do anything with me or not. She goes, you're right. The question you have to answer yourself is, do you want to pick up an extra $3 grand a month, roughly, when this is all said and done, income for the rest of your life or not? That's the question you have to answer because you're doing this anyway. She goes, I see your point. Contact me for more information, toll-free 866-268-4422 or yourpersonalbank.com for more information.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.